Want to trade futures profitably but not sure where to start or what they even are? Then you are in the right place. In this video, we'll answer 3 burning questions. What are futures and how do they work? How do crude oil, gold, and index futures differ? And how can you start trading futures? We've put together this comprehensive guide to demystify futures trading for you. By the end of this video, you'll have a solid understanding of how futures markets operate. Plus, we'll share some expert tips to help you get started. Ever wondered how traders can predict the price of commodities, like oil and gold, months in advance? Imagine you're a farmer growing wheat. You want to lock in a price now to avoid the risk of prices dropping at harvest time. Futures contracts let you do just that. By agreeing today on a price for delivery in the future, you secure your financial stability. Futures are standardized contracts traded on exchanges, allowing buyers and sellers to agree on prices for various assets to be delivered at a future date. This helps in managing risk and speculating on price movements, which is important to US traders. Why do traders flock to futures contracts for crude oil and gold? Crude oil futures are critical for energy companies and airlines to hedge against price volatility. Meanwhile, gold futures attract those looking to protect against economic uncertainty. Index futures, on the other hand, allow traders to speculate on the performance of stock markets as a whole, like the S&P 500. Each type of future serves a unique purpose. Crude oil futures stabilize energy costs, gold futures act as a safe haven, and index futures provide a way to bet on or hedge against market trends. Curious about how to start trading futures yourself? Trading futures involves understanding margin requirements and choosing the right broker. Margins are essentially a good faith deposit to ensure you can cover potential losses. Brokers provide the platform for you to trade, with popular ones being TD Ameritrade and Interactive Brokers. To trade futures, you'll need to open an account with a broker, meet the margin requirements, and understand the leverage involved. Remember, with futures trading, you may lose more than you initially put in, so it's crucial to manage your risk and stay informed about market conditions. How do futures exchanges like the CME ensure fair trading and transparency? The Chicago Mercantile Exchange, CME, is one of the largest futures exchanges in the world. It offers a centralized marketplace where traders can buy and sell futures contracts. The CME ensures that all contracts are standardized, which means each contract for a specific asset is identical, making trading straightforward and fair. Unlike CFDs and Forex, where prices can vary between brokers and spreads can widen against traders, futures trading provides a fixed price visible to all, regardless of the broker. This makes futures trading a more professional and transparent way to trade. Thanks for watching Money Mastery. If you found this guide helpful, check out our video on what is Forex for more insights into the financial markets. Don't forget to subscribe for more tips and strategies on trading.